Hi there everyone and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances and you need to decide for yourself whether it's appropriate to you. Alrighty, so we saw our market pull back quite a bit today, despite positive leads coming out of the futures in the US and positive leads throughout most markets. Japan also was in the red today, but as we speak, we've got Dow futures up about 80 points. Chinese markets have come up into the green. So yeah, quite a surprising pullback, really a bit of a disconnect to world markets at the moment. Technically, we're still a bit of an uptrend. I think as long as 7200 holds, the longer term trend for me is still in play. The only difference is now is we're not as on a steeper trend as what we were before. Okay, so we're now drawing our trend line to a little bit more sort of flatter, and I guess that's a healthy thing. Really, the steepness of the old trend that was through here for me couldn't last, right? So we're drawing something like this, and that was just a little bit too steep. That broke maybe a month ago. Now we're looking at maybe a bit of a shallowing trend through here. But for now, in the short term, we're stuck in a pennant pattern. If 72 breaks, it'll become a bit more bearish. But then, obviously, we'll have a few targets short after that. One will be the 200-day moving average. The other would be the 10% correction level around 6,900. Otherwise, I do believe we'll likely break to the upside. Okay, I think that's a more likely scenario here. But obviously, we're waiting for technical signals to indicate whether we're right or wrong. 74 is the level I'm looking. Which is obviously that downtrend line as well as recent resistance. So, really for the short term, I think we're stuck between those two levels for a little while here. But ultimately, towards the middle of October there, or even a little bit sooner, we'll probably break out. So that's our market. Really, not much else to say other than it looks a bit sideways in the short term, a little bit bearish in the short term, and we'll go from there. Get across the S&P 500. This is where we're a little bit surprised our market's coming off so much. Their longer-term uptrend line has also broken, so we'll probably find that they'll end up in a similar situation where they'll establish a shallower trend. But I just can't see that trend turning to down just yet. I don't think we've found the top. But let's just find out, right? Only time will tell. So for now, they've had a bit of a pullback, a bit of a weak September, which is very, very common to see. They have popped back up to test a level of resistance here, and we're just waiting to see whether it's going to break up and push up further or pull back once again down towards this 43. Only time will tell. Okay. Once again, I think we're in one of those sort of uncertain times. September's a bit of a bearish month, and we're just sitting here questioning whether we found the end of that or not. Alright, so quite a bit going on actually this week that could cause a bit more volatility. For one, Evergrande is due to pay another round of interest coming into tomorrow and Thursday. Let's see how they're going to handle that. The Chinese markets at this stage are shrugging that off pretty well. They're up into the green today. Let's just see how that plays out over the week. The big one for me really is the debt ceiling. We've seen this cause issues before. There's a lot going on around this at the moment. So basically, the Democrats need to increase the debt ceiling by the end of the week. Okay, that's the deadline. If they don't hit that deadline, the government will start shutting down non-essential services. So we're talking about rangers in parks and cleaning the streets and things like that. Right, non-essentials. Essential services will continue, right? So look, we've seen this happen before in Obama, as well as Trump had a period of time where they had government closures because of the debt ceiling issue. If memory serves me correct, both times the markets came off a little bit. It wasn't a huge volatile event. It wasn't something that caused a correction. It was just weakness in the market with the uncertainty. Okay, so look, that could play out this week. I think that will really see a lot of investors on the sidelines waiting. Okay, it's one of those scenarios where you wouldn't really sell into it as such, not in a major way. You'd wait to see which way it goes. But for now, I think we'll see a bit of sideways into that bit of news towards the end of the week. Tied to all this as well that we need to keep an eye on is also Biden's stimulus and budget plan. Okay, that's the big one for me as well. Can he get his infrastructure bill finally through? Can he get the rest of the $3.5 trillion through? What's tied to all the rest of this as well is potential tax hikes, corporate tax to come back up a little bit as well. Let's just see how this plays out and how the market reacts. It's not positive stuff, right? But for me, it's not negative to the point where I think the trend's going to turn to bearish either. I think a little correction here, which we're already seeing, maybe a little bit more of a pullback on the back of this, depending on which way it turns. But then from October onwards, we're looking pretty bullish. Like middle of October, about 2.5 weeks from here, US reporting kicks off. The last reporting season, a lot of companies gave pretty bleak forward guidance. Therefore, we'll likely see another reporting season where companies will beat expectations. I do believe things really aren't as bad out there as what they could have been, okay, through this whole COVID period. Because as we came towards the end of last reporting, we were seeing the COVID cases rise. As we're coming into this reporting, the COVID cases are starting to fall. So sentiment's a little bit different. It's all about reopening right now, okay? It's all about vaccine targets and it's all about reopening. So with worldwide COVID cases coming back down again, people are starting to feel a bit more optimistic about the reopening play. So travel stocks are going up, oil's going up, energy stocks are going up. We're seeing a little bit of strength in our banks as well this week because of also the shift in bond yields as well as sentiment. So, right now it's all about vaccine targets here in Australia. We're seeing every day that's what they're reporting on. The amazing thing is New South Wales is hitting up near 85. It won't be too long before they hit 90% of their eligible population to hit their first dose, right? Which means most of those people will get a second dose, which means next month or two we're going to hit those 78 to 80% targets. Okay, so I think we're doing very, very well considering we're late to the race. Okay, we're playing quite a bit of catch up here, which is very, very positive, guys. Okay, this is very positive, and this is where I think markets will turn back to bullish sort of towards that middle of October once we get past this debt ceiling issues in the US. Okay, so I think that's weighing things down at the moment. The other big thing is iron ore. Okay, so we saw a little bit of a recovery. The miners tried to recover a little bit early to late last week on the back of iron ore pushing up a little bit. We saw iron ore at 119 last night on the port, but futures have come straight back off today. If you look at the chart of the Dalian iron ore futures, there is a clear downtrend line that it reached today, and it's pulling back off that line already. And that's why we're starting to see miners down, okay? So today is because of iron ore coming off on the futures markets. So this is where the Aussie market could hold back a touch here. If the miners join the race, we got banks holding up, miners join in, we could easily see a bullish market back up to 7,600 through October. So the Fed last week, obviously they came out to suggest that they're going to start tapering bonds soon. The Fed members are split halfway through the middle to suggest when they believe interest rates are going to go up. Half believe middle of next year, the other half believe 2023. I personally think it won't be until 2023. Fed Chair Powell was fairly clear that he was in no rush to get interest rates going up after they stopped tapering bonds. Okay, so let's just see how this plays out. For now, what we're seeing on the markets is that the bond yield curve is actually steepening again, which is really quite positive for the banks. It also gives a positive outlook for the economy. Okay, so a steeper yield curve is usually a leading indicator that we're heading towards more positive economic growth, where a shallowing or a flattening of the yield curve is suggesting we're going towards recession. So we've got some forward indicators there that are a little bit positive. Also, as people are selling out of the bond space, what we could see is money flow towards equities again in the coming months. So let's just see how this all plays out. Like I said, we're in an uncertain week or two here, but we should find the bottom soon, and this will be a very good buying opportunity, I believe, coming into the end of the year. Okay, so really not much else to say. Really, we're in a little bit of limbo with this debt ceiling issue, and we just want to see how that plays out before we pile into too many more trades. We are in a few trades at the moment still. Okay, a couple of bearish, but mainly still bullish trades. Okay, overall, because we do believe that we'll get back into that bullish gear pretty quickly at some point throughout October. Okay, all right, so that's where we're at. Thanks for listening in. Take care, and bye for now.